Okay, so what if I told you that a company could be incredibly profitable and totally bankrupt at the same time? It sounds crazy, right? But it happens all the time. It all comes down to a really dangerous blind spot, confusing the profit you see on paper with the actual spendable cash in the bank. And let me tell you, understanding this difference is not just a smart business move, it's about pure survival. This quote right here, it absolutely nails it. You can have all the record-breaking sales and amazing profit margins in the world, but if you can't actually pay your suppliers or your team because all your cash is tied up somewhere else, well, that profit is basically an illusion. That's the blind spot we're going to put a spotlight on today.
So if the profit statement can sometimes be, well, a bit of a mirage, where do we look for the truth? How do we actually follow the money, not just the numbers on a spreadsheet?
The answer, my friends, is the cash flow statement. This thing is the ultimate truth teller. It doesn't care about complex accounting rules, it just follows the cash. But, and this is the absolute key, there are two completely different ways to put one of these together, and each one tells a very different story to a very different audience. Think of it like this. You've got two different perspectives for two totally different audiences. Over on the left, you have the indirect method. That's the accountant's view. And on the right, the direct method, which I like to call the leader's view. Let's start with the one you've probably seen before, the one that shows up in almost every official financial report.
Right, so this first one, the indirect method, is all about one thing: reconciliation. It's the official standard, the one you'll find in audited financial statements, and its entire purpose is to build a bridge, to explain exactly how that profit number on one side connects, or more often doesn't connect, to the actual cash on the other.
So how does it actually do that? Well, it starts with a number we all know and love, net profit, that famous bottom line from the income statement. And from there, it kind of works backward, making a whole series of adjustments to eventually get back to the cash reality. Let's just walk through the logic here. First, you grab that net profit number. Simple enough. Then, you have to add back expenses that aren't actually cash leaving your account. Think about depreciation, right? It lowers your profit on paper, but did any actual money leave the building? Nope, so you add it back in. And finally, and this is a big one, you adjust for real-world timing. You might have made a huge sale, so your profit looks fantastic, but if the client hasn't paid you yet, your cash is still at zero for that sale. This step is what corrects for that kind of lag. So you might be asking, why even bother with this roundabout method? Well, it's the official standard for a reason. It's absolutely perfect for auditors and analysts because it shows them the precise link between the reported profit and the cash flow. But, and this is a big but, if you're a business owner just trying to figure out, hey, can we afford to launch this new project next week? This report is not going to give you a quick answer. It just wasn't designed for that.
Okay, now let's flip the script completely. Let's talk about the other side of the coin, the direct method. With this one, you can forget all that stuff about reconciling profit. This is about pure, simple, unadulterated cash visibility. This is the tool for leaders who need to make decisions like now.
The beauty of the direct method is that it is brutally simple. It completely ignores profit. It starts and ends with your bank account. It's basically just a list. Here's all the cash that actually came in, and here's all the cash that actually went out. Period. End of story.
And that's exactly what makes it so intuitive. You just see it laid out. Actual cash collected from customers. Actual cash paid to suppliers. The money that went to payroll and rent. There are no confusing accounting adjustments, just the cold, hard facts of your cash flow.
Ultimately, the direct method is so powerful because it answers the two most important questions any leader has. Where did our cash come from and where did it go? It cuts right through all the accounting noise and gets straight to the point. So, what we have are two methods. One for reporting and reconciliation, and another for operational visibility. And listen, neither one is better than the other. They're simply different tools for different jobs. You wouldn't use a screwdriver to hammer a nail, right? Same idea. This table here really lays it all out. Look at the direct method. It starts with cash, it's highly transparent, and it's built for operators and CEOs. Then you have the indirect method. It starts with profit, it's way less transparent because of all the adjustments, and it's really designed for accountants and auditors. It's all about picking the right tool for the job. And here's the kicker, the really wild part. After all those different steps, those completely different starting points, both methods arrive at the exact same final number for net operating cash flow. In the example from our source material, that number is 9,700 pounds. And that just proves the point, doesn't it? It's not about which calculation is correct. It's about which story you need to hear at that moment. So look, if you remember just one thing from this entire explainer, let it be this.
The direct method is for visibility, seeing the reality of your day-to-day cash. The indirect method is for reconciliation, explaining the difference between that reality and your reported profit.
And that leaves us with one final question to think about. When you look at a company's performance, maybe even your own, are you seeing the tidy, adjusted story of profit? Or are you seeing the messy but undeniable truth of cash? Because as we've learned today, only one of them really tells you if you can open the doors for business tomorrow.